The International Monetary Fund (IMF) says African exporters of oil and commodities should remove subsidies and boost taxes to weather the slowest growth in more than 2 decades. The Washington-based fund cut its 2016 growth forecast for Sub-Saharan Africa by more than half to 1.4% from an initial forecast in May of 3%. The rate of IMF's African department says growth could start to recover next year to 3%, only if the battered economies carry out fiscal reforms.
The key risk is really whether or not countries will go ahead and do the required fiscal adjustment. Should they fail to do that, I fear vulnerabilities will heighten, and the crisis and the weak economic performance we've seen so far could get even more difficult.
Economies grew more than 5% in a decade, leading to the commodity price drop, but it's now being dragged by 23 resource-dependent nations like Nigeria, South Africa and Angola. Nigeria, which is in its first recession for more than 20 years, has been seeking to widen its tax base to offset lower revenue caused by the slump in oil prices.
Now, the good thing for Nigeria is they have a fairly low level of debt. So Nigeria is a country where if you have a coherent and consistent policy package, it should be possible for them to to get financing to support gradual and smoother adjustment paths.
Selassie says African nations needed to balance commercial debt like Euro bonds with other cheaper forms of financing from development institutions.